If you think that once you pay for your investment home, you will be blessed with a lot of passive income, then you are wrong. Real estate is no easy game, at least for most people. It requires a lot of money as investment. There are so many things you need to look out for when buying an investment home. Yes, even today when it comes to investments, real estate is still an attractive option to make a lot of money. But sometimes things can be confusing, especially if you are new to real estate investments. But it's okay, I got you covered. An investment home can be one of the smartest financial decisions that you can make, especially if you do it right. You can get strong returns in passive income, tax benefits, and equity gains. But like any other investment, big returns are not a guarantee, so you need to come up with strategies when choosing and purchasing your investment property. And you also need to learn about the current market trends and general guidelines, because all of this will dictate whether your investments will help you become financially free. I know you already read the title, so in this video, I'll be taking a look at 5 things you need to look out for when buying an investment home. 5. Risks. When it comes to any investments, you need to understand the risks you will be dealing with. And with real estate, the story is no different. You might not get the rental interest that you anticipate. Sometimes, you could also end up having to pay up front for expensive repairs. In the future, property taxes could go up. The local economy could change. You might have to deal with bad tenants, which will result in huge repair costs and maybe even a lawsuit. But this shouldn't turn you away from buying an investment house. What I'm trying to tell you is that you should not ignore the risks involved in buying an investment house. Keep in mind that no investment is a guarantee, so make sure that you're not putting all the eggs in one basket. Every market can have its own ups and downs, which primarily depends on interest rates, inflation, and several other market trends. Investors may not be able to eliminate market shocks, but what they can do is hedge their bets against booms and busts with a diversified portfolio and strategy based on general market conditions. You should also take into consideration the depth of the market and have a proper exit strategy even before you buy an investment property. Real estate markets can be unpredictable. In most cases, real estate prices tend to rise over time, but on rare occasions, your investment could also depreciate depending on supply and demand, the economy, demographics, interest rates, government policies, and several other unforeseen events. But you can lower the risk of getting caught on the wrong side of this wave if you are careful enough to do your research and monitor your real estate holdings. 4. Underestimating costs. Your investment home is not a once-and-done purchase. There are several maintenance costs involved if you really want to get the most out of your investment property, and sometimes it is not always possible to anticipate these expenses with complete accuracy, which is why you need to plan your budget appropriately and make sure that you won't end up red towards the end of the year. Variable expenses are even harder to predict, so make sure that you leave enough room in your budget for unexpected costs, like needing to replace the water heater or sometimes even fixing the roof after a bad storm. Now, if you've made it this far, consider subscribing to my channel for more personal finance-related content just like this one, and turn on post notifications so that you get notified whenever I upload a brand new video. Now, operating expenses on a rental property will be about 35 to 80% of your gross operating income. Let's say that if the monthly rent is charged at $1,500, expenses will be at around $600 per month, which is about 40% of the operating expense. Investors tend to use the 50% rule, so if the rent is $2,000 per month, you need to expect at least $1,000 in total expenses. 3. Condition of the house. When it comes to buying an investment house, you need to be very realistic with your goals. You need to investigate the condition of the house to get a better deal. Some real estate investors choose to flip houses by purchasing a house below the market rate and then do some repairs and resell it for a higher return. If you're only interested in a newly constructed house, the condition of the house might not be something that you need to worry about. But if you're willing to look at all the houses in your price range that meet your basic requirements, you might be dealing with homes that are at least several decades old. Older homes definitely have a character that will appeal to you, but they will also need more repairs and upgrades. 2. Property taxes. For those of you who don't know, property tax is the one that is paid on a property owned by an individual or any other legal entity such as a corporation. The tax is usually based on the value of property, including the land. But there are many jurisdictions where even tangible personal property is like cars and boats are taxed. People often use the terms like property tax and real estate tax interchangeably. Well, it might be partially true that real estate tax is a form of property tax, but a property tax is not real estate tax. To put things into perspective, real estate taxes are taxes on real property only, but property taxes can include both real property and tangible personal property. Property taxes in general will vary widely across your target area. You might be thinking high property tax is something that you need to avoid, but that is not always a bad thing. especially if the property tax that you have your eyes on is in a great neighborhood that attracts long-term tenants. But then there are unappealing locations with high taxes, so these are the places that you need to avoid. Make sure to find out if property tax increases are probably in the near future. A town in financial distress may hike taxes far beyond what the landlord can realistically charge on rent. This might result in negative cash flow. 1. Location. When it comes to buying your investment house, location should always be your top priority, because once you buy it, you cannot move the entire house to a more desirable location, nor can you move a retail building out of an abandoned mall. Your ability to make profit from your investment house will largely depend upon location, because it ultimately drives factors like the demand for rental properties, tenant pool rental rates, and potential for appreciation. As a general rule of thumb, the best location is the one that will generate the highest return on investment. You have to do your research to find the best locations so that you don't hurt your cash flow. For those of you who don't know, cash flow on real estate investments refers to the money that is left over after you end up paying for all expenses, taxes, insurance, and mortgage payments. Negative cash flow happens when the money that is coming in is less than the money you spent. This means you're losing money, and there are several reasons for you to lose money. For example, high vacancy rates, extremely high maintenance, and high financing costs on loans. Sometimes you don't simply charge enough rent, or you might not be using the best rental strategy. All of this can affect your cash flow, so the best way to reduce the risk of negative cash flow is by doing proper research before buying a property. That being said, every state has good cities, and every city has good neighborhoods. Every neighborhood has some great properties. You need to do your research to find out what fits your budget. Make sure to keep your expectations realistic and make sure your own finances are healthy enough, because real estate has never been a quick rich scheme. It will take some time for your property to start generating cash, especially if you have invested money in renovating your investment home, which is an added expense on top of the mortgage that you are paying for. Also, keep in mind that real estate is not an asset that is easily liquidated. So if the property that you're buying is a wrong one, it will affect your returns negatively, and that's something that you need to stay away from. This is not a financial advice video by any means, so invest your money at your own risk, as investments can be totally unpredictable depending on market trends. Like any other investments out there, a rental property is a long-term project. An investment home can be a very lucrative way to get into real estate, especially if you desire a steady passive income. Keep in mind that investing in rental properties requires knowledge about tenant and landlord laws. An investment home will also build your portfolio with appreciating assets and will also help diversify it. I'm excited to see what kind of investment home you will be investing in.